Welcome back to this, the fourth and final of the videos in this series of capital budgeting videos. In this session, we're going to take a look at some of the special applications of capital budgeting theory, having already covered some of the basics, including things like net present value, internal rate of return, modified internal rate of return, profitability index, and payback period. In this session, we'll look at a couple of special examples of using capital budgeting techniques, and we'll have a final discussion of some of the problems or some of the issues related to capital rationing. In our first example, we have to deal with a particular problem of valuing two projects, or rather two different business opportunities. Both of them are solutions to the same type of problem. For example, if we have a choice of buying two different machines, one of those machines, one of those different alternatives, and they have to be mutually exclusive for this to work. One of these alternatives will last you for 4 years and provide you with a stream of cash flows divided over those 4 years. The other project will only last for 2 years. Both projects, let's say, will cost about the same amount of money, but they have different lives. For example, what if you were setting yourself up in a business that was going to, basically a taxi business. You're going to operate an Uber, and you had a choice of two different alternatives. You could go for the fully electric vehicle that's going to last you for 4 years, and after operating costs is going to provide you with a revenue of $33,500 per year over the 4 years. So year 1, 2, 3, and 4, each year you have the same level of cash flow returns. The opportunity is going to cost you $100,000. The other alternative, again, costs $100,000, and it's going to provide you with a higher rate of return of $60,000 per year. In this case, the return is going to be a little bit higher because the operating costs are going to be lower. But after 2 years, the asset is no longer going to work. Let's say this is going to be a hybrid petrol-electric vehicle that you're going to operate. Which one should you choose? Well, we can apply our standard NPV techniques in order to determine what the rate of return is to these two investments. Again, we have a simple assumed weighted average cost of capital of 10%. If we look at these cash flows, and in fact we can do this with our calculator, we could put in the cash flow in period 0. In both cases would be minus 100. For the hybrid electric vehicle with the $60,000 per year cash flow for 2 years, cash flow in year 1 would be $60,000. Cash flow in year 2 would be $60,000. So we have a frequency of 2. We have the interest rate of 10%. And if we solve for the NPV, we'd see that the NPV of the first project of the hybrid electric will be $4,132. If we go for the other project, Project L, we have got the $33,500 that we're going to receive. We're going to receive it as an annuity for 4 years. So our N is going to be 4 in that case. Again, our discount rate is 10%. When we solve that one for the NPV, we find that it's actually going to be a higher NPV. And our rules say mutually exclusive, go for the project with the highest NPV. But here's the thing. If we invest in Project L, we're going to earn that money on our investment over those 4 years. If we invest in Project S, we work for 2 years. What do you do for the next 2 years? Well, clearly you could reinvest in a second vehicle, another $100,000 investment, another $60,000 per year for the second two-year period, and we could earn our annuity all over again. We could earn that NPV all over again. So the adjustment that we make in order to determine which is the best investment is going to turn that NPV of the project into an annual NPV or an annuity. The approach we use is called the equivalent annual annuity approach. And essentially we turn the present value for each of those 2-year or 4-year periods into a standard annual return, a standard annuity. To do that, we put that information into our calculator. For the S project, the all-electric project, N is equal to 2. Our cost of capital is still 10. We put in our present value as minus 4132 into the calculator. The future value equal to 0, and solve for payment. In fact, we can take a look at that with our calculator. And so if we put that information into our calculator, N is equal to 2. 2 is N. Interest per year, 10 interest per year. Present value, 4.132, and that's in thousands, and that has to be a negative because it's our present value. And our future value is equal to 0. If we click on Compute Payment, that gives us the annuity value. And that's going to be a return of $2,380 per year for each of the 4-year periods. We can do the same thing again for our second project, Project L. And remember, that was the all-electric vehicle, which would last for 4 years, and it would provide us with a bigger single present value of 6,190. We put that information into our calculator. The annuity that it provides is 1.95 or $1,950, which is actually smaller per year than the annuity for the hybrid electric alternative, the first one. So we'd be far better off not taking the second one with the higher present value, but taking the one with the highest annuity value. So since Project S has the higher equivalent annual annuity, it's a better project. I've also modeled this one on our spreadsheet, which you can see in VIU Learn. And so here I put in the value of the two projects, the cash flows for Project S, the cash flow for Project L. The NPV solution is just the NPV function that we saw before, and so we've calculated that. But now I input information about the number of compounding periods, 2 and 4, and I use an annuity function. It's actually called payment, equals payment, and the data that it needs, the discount rate, the number of periods from cell B9, the value of the present value, the NPV, the present value information, but it has to be a negative. And then I have information about the future value, which was just 0. So when I put that information in, I get the value of the annuities. And here you can see what the cash flow chart looks like. I make my investment. If I've invested in Project S, I get 60 and 60. If I invest in Project L, 100,000 investment gives me 4 returns of 33,500. What do I do after year 2? Well, I can reinvest in the project and repeat the cycle all over again. So even though I get the higher present value from Project L, I would be better off doing Project S twice. That's the kind of decision that we have to make all the time. Do I go for machine A or machine B? Machine A will last longer than machine B. Do I drive a Volkswagen or do I drive the BMW? Well, the BMW will last longer, so perhaps I should go for the BMW, or should I go for 2 Volkswagens? That is the kind of problem that we solve with the equivalent annual annuity problem. That's one of our applications. The second application looks at the economic life versus the physical life. Again, you can apply this problem to a machine, or you could apply it to a mine. If you imagine a mine, we're going to invest $100 million to create a copper mine in Peru, and that mine could last for as long as 20 years. At some point, we're going to stop the operations because the yield on the mine falls below a certain threshold value. Or perhaps if we have a machine, if we buy this machine, it could last for 10 years, but after 5 years, the cost of maintenance is going to increase. And every year the cost goes up and the efficiency goes down. And also we have a salvage value. If we sell the machine in year 6 second-hand, we know that we can get this percentage of the total purchase price value as a second-hand machine. If we wait till the end of its physical life, it's good for nothing. We have no scrap value or no resale value. So the purpose of this approach is to take into account all of that extra information. Normally when we look at projects, they're analyzed under the assumption that the company will operate the asset until the end of its life. If we take a look at an example of a project with a 3-year physical life, if we only operate it for 1 or 2 years, we have some salvage value. We have some resale value. Should we operate the project for the full 3 years, or perhaps stop after 1 year, or perhaps after 2 years? Well, we can take a look at the information that we have. And in this instance, our information essentially says if we operate for no years, then we're going to have the full value of our salvage value. So we'll spend $4,800 to buy the machine, and we can sell it for $4,800. Appears to be no value in that. If we operate it for 1 year, we'll earn a cash flow of $2,000 to offset against the purchase price, and we could also have the salvage value. If we operate it for 2 years, then we'd have the cost less the cash flow, and we'd also have the salvage value. And after 2 years, the value of the asset would be $1,650. If we go the full 3 years, we'll get $2,000, and maybe operate and earn $1,750 in the 3rd year, but with no salvage value. If we plot those, taking a look at the value of the cash flows under these scenarios, with the full 3-year operations, cost $4,800, earn $2,000, and $1,750. Operate for 2 years, $4,800 cost, $2,000 we earn in year 2, $2,000 we earn in year 3, plus $1,650, the salvage value. And if we operate, we don't operate at all, we shut down in the 1st year, well, we spend $4,800, we earn $4,800. With this information input into our calculator or spreadsheet, we see that the valuation that we get, if we operate for the full 3-year period, we end up with a negative NPV of $1,412. If we operate for 2 years and then shut down and earn the salvage value of $1,650, we're going to have a positive NPV of 34.71. And if we don't operate at all, well, basically we lose the cost of capital, the carrying cost, and that's going to give us a negative NPV of 254. The only way this project works is if we run it for 2 years and then shut down. So the lesson from this one is that a project's optimal life, its economic life, is not equal to its physical or its engineering life. It's equal to the amount of time that gives us the greatest positive value. And that's why we see things like a machine is going to be sold off after 2 years because its efficiency falls and cost of maintenance perhaps is rising, and it makes more sense to start another replacement cycle. The idea that every business has an optimal capital budget, it should be a very simple and foregone conclusion. We should invest in every project that produces a positive NPV. If we have 100 projects or 1,000 projects or 6 projects, as long as the projects have an NPV greater than or equal to 0, we should go ahead. There's a problem with this in the real world. Most companies don't have the capacity to do all of the projects that look like they're worth doing. And these things happen, these things reach certain limitations for a number of reasons. One of them would be that if we try to raise too much money too fast, we're going to run into a rising marginal cost of capital. That doesn't make sense according to the finance theory, because the finance theory essentially says that while a company is able to continue to produce positive NPV, it should have unlimited access to new capital. But we know in the real world, if you do try to go out and raise money by selling stock and then raise money by additional debt and more stock and more debt, that the investors are going to become nervous and they're going to require a higher degree of compensation. They're also calculating your debt-to-equity ratios or debt-to-asset ratios on the basis of last year's results, not on the forecasts. So that could be a problem, an increasing marginal cost of capital. We also have got the standard problem of capital rationing. I'll come back to that one in just a minute. but increasing marginal cost of capital just says if you have to go to external markets, there are going to be flotation costs. The flotation costs are going to increase the overall cost of capital. Large capital budgets are seen as risky, which drives up the cost of capital, not just for your new projects, but for your existing operations. And if we're going to go into external markets, then the NPV of all the projects need to be evaluated using the forecast higher marginal cost of capital, which makes a lot of those positive NPV projects not nearly so good. Now, remember what I said at the beginning, that according to finance theory, there should be no problem raising capital for projects with positive NPV, whether there's one project or 1,000. The real-world conditions suggest that there is capital rationing, and it generally occurs. It's generally demonstrated by companies not investing in all of the positive NPV projects. Perhaps there's going to be a limit to the ability of the company to manage that many new projects. Perhaps they haven't got the managers, or there may be another scarce resource, perhaps physical locations. We can't lease enough good properties in the short term to be able to take advantage of all the new opportunities. Generally, companies will set an upper limit. They'll say, we will invest up to 10 million or 100 million or $1 billion a year in new capital projects, and that will be the limit. That's an artificial limit. It suggests that there's capital rationing. And often it means that not only do we not invest in all of the positive NPV projects, but perhaps we make some unusual allocations to fit in a few small projects just to use up our extra bit of a budget. There's a good example from another textbook, and this particular one says, what if our company has got a 10% cost of capital? So just looking at this number, it says here cost of capital R is expressed with a K because it is a different textbook, and sometimes we do that. 10% is our company's weighted average cost of capital. And we have got all of these different projects. We've got project A, B, C, D, E, F. They're all good projects except for, well, project E and F don't give us a rate of return on invested capital that's as high as our cost of capital. So we probably would never do those. We'd probably never do E and F. However, A gives us about a 16% rate of return, and B gives us maybe a 14%, and C gives us maybe 12%. D also gives us about an 11% rate of return on our capital. So they're all good projects. However, the company says we're not going to invest in more than $16 million in projects. And that means project A looks like a brilliant one. It's going to cost us $8 million. And this is the dollar value across the bottom axis. That's expensive. It's going to use up half of our budget, but it's giving us more than a 16% rate of return. So that's definitely going to be one that we're going to go ahead with. And same thing with project B. That's going to cost us another $5 million. And that'll take us up to a total of $13 million of our $16 million capital budget. That also is going to be a clear winner. We're going to do that one. What about project C? That is a project with a really good rate of return. It's giving us about a 12% rate of return. Would produce positive shareholder value, but here's the catch. It's going to be about $6 million in costs, and 6 million on top of 13 would take us to 19 million. That's above our budget, so we can't do that. But what about D? D is going to give us a lower rate of return, maybe only about 11%. Not nearly as good a project as C, but it's a bit smaller. It's only going to cost about 3 million. So we can do A, B, and D. They're all going to be positive NPV projects. They'll fit within our 16 million. 8 plus another 5 plus another 3 gives us exactly 16 million. So we do A, B, and D, but we wouldn't do C. Now, does that make sense? C was a better project. It had a higher rate of return. It would create more shareholder value, but we're tossing it out along with these other projects that don't produce a high enough rate of return. That's exactly what capital rationing looks like. Maybe that project can be done next year, or maybe that project will disappear. But It's definitely a problem that the academics say should not exist, because in a perfect world, all projects with positive NPV will attract funding. There are a number of other reasons. One reason why a company would establish a boundary is it says that if we try to float too many projects at once, we're going to run into the cost of that higher marginal cost of capital. We don't want to issue new stock because we have flotation costs, and also it's going to possibly result in dilution. It will result in our share prices falling, and remember, our managers are often compensated with stock options. So if new projects create shareholder value but make the managers worse off, we've actually got an interesting agency problem. One of the ways around this is to increase the cost of capital enough to reflect all the costs and then accept the projects that still have positive NPV. So in other words, we said 10%. What if we said 12%? That might also drive out some of our good projects that only had an 11% rate of return, but it would allow us to do the projects that we can do, like Project C. It would allow us to avoid the capital rationing problem. I mentioned earlier we might have some other constraints on the business. We don't have enough management or enough marketing talent, enough engineering staff to implement all of the positive NPV projects. And of course, now we have got multiple constraints, and that suggests that this problem isn't just going to be solved with finance, it needs to be solved with those other factors. And for that we use things like linear programming models to optimize the project value. Another reason why a lot of projects don't get done is because managers don't believe the forecasts. And of course, when we make an estimate, there's always going to be a chance that we're going to put in some incorrect information. Of course, it's a forecast. It's not a fact. So what happens if managers stop believing the forecasts? Well, effectively, they're going to apply a higher hurdle rate. Now, hurdle rate is a term we haven't used before, but essentially that's a number that's higher than the weighted average cost of capital to accommodate that estimate bias. We believe the true weighted average cost of capital is 10%, but we think that people are going to exaggerate to a certain degree. So instead of using our true weighted average cost of capital of 10%, we use 12%. And that difference is largely just manufactured out of thin air and means that companies often miss out on a lot of good projects. So that creating that to filter is a problem. Now, the better solution is actually to take a look back and do an audit of the projects that we approved and we didn't approve in the past, and see which managers put forward capital budgeting proposals which actually delivered what was promised. And then if managers are not capable of producing the returns that were promised in their forecasts, those are the ones we should be penalizing, not the managers who actually hit their forecast targets. In this session, we looked at a couple of particular problems or applications, and we looked at the idea of trying to evaluate two projects with different lives. We learned that the equivalent annual annuity approach solved that problem. We also found that there was a simple solution to dealing with salvage value and the need to stop a project before it reaches the end of its fiscal life. And we very quickly visited the idea of capital rationing. Thanks for your attention, and I look forward to seeing you in my next class.